Ethereum calls itself decentralized, yet more than half of its nodes run on just a few US-based cloud providers. Three major hosts, Amazon, Hetzner, and OVH, account for about 69% of Ethereum node hosting, with over 50% on Amazon Web Services alone. A single government order affecting those data centers could temporarily disrupt a network designed to be unstoppable. Welcome back to our series, where we break down crypto projects in a clear, actionable way so you can decide if they're worth your time. Just a quick reminder, this isn't financial, tax, or legal advice. Always educate yourself and do your own research. Today, we're diving into Ethereum, the second largest cryptocurrency and longtime king of smart contracts. But can it hold that crown as faster rivals close in? By the end of this analysis, we'll put it to the test and give Ethereum a final score out of 100, team and development. Ethereum's growth is driven by a global community of developers, with Vitalik Buterin as its most visible co-founder. Unlike projects tied to a single leader, it is maintained by hundreds of contributors worldwide and guided, though not controlled, by the Ethereum Foundation. Key upgrades highlight this steady innovation: the 2022 merge to proof of stake and the 2024 Dencun upgrade, introducing proto-danksharding. This consistent decentralized progress could explain Ethereum's strong score here. However, it's undeniable that if something were to happen to Vitalik, Ethereum's price would likely drop significantly, demonstrating how the market still perceives him as the head of the whole project. There's also an unwritten understanding that developers often seek his approval. Score 6 out of 10. Use case and utility. Ethereum is the core smart contract platform for decentralized apps, powering DeFi protocols like Aave and Uniswap and NFT marketplaces such as OpenSea. Through smart contracts, it enables programmable money, decentralized governance, and verifiable digital ownership at scale. It still holds approximately 59% of DeFi TVL and leads NFTs with over $44.9 billion in all-time sales and multi-billion quarterly volume. Despite cheaper or faster rivals, network effects, liquidity, and developer depth keep Ethereum the default launchpad for serious projects. Score 10 out of 10. Tokenomics. ETH fuels transactions and secures the network through staking, and its supply can even shrink. About 332,000 ETH burned since the merge. Roughly 25% of all ETH, approximately 30 million, is staked, earning 3 to 4% yearly, but over half that stake is controlled by just 5 providers. Lido alone about 28%, Coinbase and Binance over 14%. Whales hold about a third of all ETH and exchanges another approximately 12%, while the Ethereum Foundation and early contributors now keep barely 1% combined, having sold most of their launch allocation. This shows strong utility and occasional deflation, but also clear ownership concentration, and that many early insiders have largely exited. Score 4 out of 10. Hype versus fundamentals. Ethereum has weathered every major crypto craze, from the 2017 ICO boom to the DeFi summer of 2020 and the 2021 NFT surge, turning hype into lasting fundamentals. DeFi activity once pushed total value locked above $170 billion, and even after market pullbacks, Ethereum still holds about 59% of all DeFi capital. The NFT wave likewise built a creator economy that remains active. Developer activity, user liquidity, and infrastructure depth keep growing through each cycle, making Ethereum the blue-chip chain that institutions and serious builders trust, while many newer chains fade after initial speculation. Score 9 out of 10. Market liquidity and volatility. ETH is highly liquid and trades on nearly every major exchange, but that also means it's closely tied to market sentiment and can move sharply when fear or euphoria hits. Its market cap and daily volumes make large trades easier than with small tokens, yet heavy institutional involvement, like the 2025 ETH spot ETF, can cut both ways. Big funds exiting at once can amplify price swings. ETH remains far more volatile than traditional assets and can drop harder than Bitcoin in bear markets. Blue chip status doesn't shield it from sudden corrections or from liquidity drying up in a crisis, which can spark a cascade of forced liquidations and selling pressure that drives prices down even faster. Score 9 out of 10. Security and decentralization. Ethereum's proof-of-stake network is secured by over 1 million validators worldwide, making it one of the most battle-tested blockchains. A successful 51% attack would require tens of billions of dollars worth of ETH and coordination across many independent operators. Extremely unlikely. Still, staking power is concentrated. A few large providers control a big share, and many nodes run on major cloud hosts, which creates some centralization risk. Score 6 out of 10. Network activity and adoption. Ethereum dominates on-chain activity. It leads in developer numbers, holds roughly 59% of all DeFi value, and remains the main hub for NFT trading. Even when users move to Layer 2 networks like Arbitrum or Optimism for lower fees, those transactions ultimately settle back on Ethereum, keeping it the ecosystem's gravity center. Score 9 out of 10. Scalability and technology. Base layer throughput remains around 15 transactions per second, and gas fees can spike. Ethereum leans on Layer 2 rollups for scale and has begun implementing proto-dank sharding, EIP 4844, as a step toward full dank sharding. Competitors like Solana or Avalanche already offer higher speeds, but often at the cost of decentralization or reliability. Ethereum's slower security-first roadmap aims for long-term robustness. Score 8 out of 10. Regulatory risks. Ethereum's proof-of-stake model and yield-bearing staking have drawn U.S. scrutiny, with the SEC warning that some staking services may resemble unregistered securities offerings. Exchanges like Kraken have already faced enforcement actions, yet Ethereum's broad use from NFTs to enterprise projects makes an outright ban unlikely. Tighter oversight of staking and exchange practices is the more realistic risk. Score 8 out of 10. Self-custody. The safest way to hold ETH is by controlling your own private keys, ideally with a hardware wallet such as Trezor. These devices keep your keys offline, allowing you to interact with DeFi protocols or NFTs without exposing them. For everyday spending, you can also use reputable software wallets like Trust Wallet, though they carry more risk since they stay online. Advanced users might choose multi-signature wallets that require multiple approvals for added protection. Always back up your recovery phrase securely and watch out for phishing links. At the CryptoVagabonds Academy, we dedicate an entire section to self-custody, guiding you step-by-step on setting up wallets, backing up seed phrases, and avoiding common mistakes so your ETH remains safe in your hands. Score 9 out of 10. Final thoughts. Ethereum still faces scalability limits and some validator centralization, yet it is still the most proven smart contract platform. Its unmatched developer base, massive user community, and strong network effects make it extremely hard to displace. Through multiple market cycles, it has shown resilience while advancing with proof-of-stake, Layer 2 growth, and the path to sharding. Competitors may boast faster tech, but catching up to Ethereum's ecosystem and Lindy effect is a steep challenge. Final score, 78 out of 100. So, is Ethereum still the king of smart contracts, or will faster blockchains take its crown? Share your thoughts below, and if there's another project you'd like us to analyze, drop it in the comments too. And as always, stay curious and stay humble.